Two people, same salary, same starting money. One buys real estate, the other buys index funds. 20 years later, both become wealthy, but one of them sacrificed thousands of hours, dealt with stress, repairs, bad tenants, and constant problems, while the other did almost nothing. And when you see the final numbers, you'll understand why this argument has been dividing investors for decades. Meet Jake and Marcus. Both are 30 years old. Both earned $55,000 a year. Both saved exactly $50,000. Same city, same economy, same starting line. But one decision changes everything. Jake buys a rental property, a $250,000 three-bedroom house. He puts down 20%, takes out a 30-year mortgage, finds a tenant paying $1,800 a month, and instantly, Jake feels wealthy. He tells friends, "My tenant is paying my mortgage." Marcus does something far less exciting. He puts the same $50,000 into index funds, then automatically invests $300 every month. No property, no tenants, no flexing, just numbers on a screen. At dinner parties, nobody cares what Marcus is doing, but feelings and math are very different things. For the first year, Jake feels like a genius. Rent checks arrive every month. Property value rises. He drives past the house and thinks, "I own that." On paper, the numbers look amazing. Rent, $1,800. Mortgage, $1,330. That looks like almost $500 monthly profit. Except reality starts arriving. Property taxes, insurance, repairs, vacancy, maintenance. One leaking pipe becomes $1,400. A broken water heater, another $1,200. One tenant leaves unexpectedly. Suddenly Jake loses 1 month rent, cleaning costs, and time finding someone new. And this is the part real estate influencers never put in thumbnails. Your tenant doesn't care that your investment spreadsheet looked good. If the AC dies in July, you pay for it. Meanwhile, Marcus is doing absolutely nothing. And that's the point. His index funds quietly grow. $50,000 becomes $61,000, then $76,000, then over $100,000. Slowly at first, then faster, then shockingly fast. Because compounding is weird. For years, it looks like nothing is happening. Then suddenly, the growth starts growing itself. Marcus has no tenants, no emergencies, no debt collectors, no lawsuits, no midnight phone calls. But psychologically, it doesn't feel impressive. Humans trust things they can see and touch. A house feels real. Compound growth feels invisible. And invisible wealth is incredibly underrated. Here's where things get dangerous. Most people compare rent income against mortgage payment and completely ignore everything else. Vacancy, roof replacement, plumbing, property management, legal issues, bad tenants, rising taxes, insurance increases. A single nightmare tenant can erase an entire year of profit. And there's another cost nobody tracks. Time. Every repair call, every contractor meeting, every tenant issue, every stressful night. Jake didn't just buy a property, he accidentally bought himself a second job. Marcus spent those same years traveling, learning, sleeping peacefully, while his investments compounded quietly in the background. Now fast forward 20 years. Jake's property is worth nearly $500,000. His mortgage is almost gone. On paper, he looks wealthy, and honestly, he did build real wealth. But after 20 years of repairs, maintenance, vacancies, taxes, stress, and thousands of hours managing the property, his final net worth lands somewhere around $450,000 to $500,000. Marcus, his boring little index fund account quietly grew to almost the same number, somewhere around $420,000 to $550,000 depending on contributions and returns. No debt, no leverage, no emergencies, no second job, just patience. And here's the uncomfortable truth. Jake worked for his money. Marcus waited for his money. Completely different lifestyles, similar financial outcomes. So, does real estate beat index funds? Honestly, that's the wrong question, because the real answer depends on your personality, your stress tolerance, your time, your goals. Real estate rewards leverage, patience, and people willing to treat it like a business. Index funds reward consistency, emotional control, and long-term thinking. But the biggest mistake people make is blindly copying someone else's investment strategy without understanding the hidden costs attached to it. Because every investment has a price. Some cost money, some cost time, some cost peace of mind. And the smartest investors aren't the people chasing the highest returns, they're the people building wealth in a way they can actually survive long enough to keep doing. So what would you choose? Real estate or index funds? Comment below and subscribe for more psychology and money breakdowns.